Welcome to the Wealthworthy Podcast. I'm Trisha.
Hi, I'm Darian.
Thank you for joining us. This week we'll be going through our quarterly check-in. So ideally, we've all been doing our investments in ourselves and investing our money. And now it's time to take a look at how we've done and what things we'll be doing going forward. One of the things that has been a primary focus for me has been trying to reallocate my funds this quarter. And we've also been looking at different ways to strengthen our skills as well as diversifying our income sources. But the area that I primarily focus on from my end is how I've been reallocating funds during the pandemic. So, of course, you all know we're still in recovery mode. So, while the economy has been in flux, the tech stocks have been roaring. They've been on a steady incline since March. And so, if you've been investing in those areas, then you've seen pretty substantial returns versus other areas of the market that's still recouping. We probably won't be back in shopping malls even after the pandemic is over. Like, our shopping habits will be changed. There's just this weight, especially when we look at all of the companies that are in the S&P 500. There's a weight of companies that are doing really well versus companies that are still struggling to get back up and running. I've still been investing for my 401k in index funds, largely the ones tracking the S&P 500 and large cap stocks. In addition to that, I've been using any additional funds in different areas to see what I like best and trying to do more research on individual stocks that I'd like to continue investing in long term. If you want to be passive, I'd say that M1 Finance and Vanguard still seem to be great ways to have a passive setup where you are investing a certain amount every month and it's going directly into your stock picks for M1 Finance, and for Vanguard, they only allow you to do that with their mutual funds. But those are great ways if you don't plan to be hands-on, because they have more limitations on how often you could buy, the time frames that you can buy. So it's not great if you're looking to be active and buy something at market price right away or buy at the best price during a certain time frame. I've been relying more on other platforms like Webull or Ameritrade, and then of course anything else like Charles Schwab, just different platforms that allow you flexibility around pre-market and aftermarket trading if you hear about something. The only thing I would warn, because like Robinhood is an option as well, but they've been running into issues with security lately. I still think it's fine for smaller amounts, and Robinhood has been urging people to use two-factor authentication for signing in. If you can pressure them to add in a little more security and contact information in case you do run into issues, then of course that's a viable option. But we really just want to be using a platform that we can trust. So that would be my main thing about just platforms in general. But otherwise, I'd say for the other portions of my investing, like things that have limitations on how you can invest the funds, like a Roth IRA or an HSA, you should look at investing in like indexes that either track the S&P 500 or are a little more aggressive. And for a little more aggressive, I like all of the ARK funds that are out there. So Kathy Woods has been amazing at navigating the space for all of the newer companies and companies showing promise. And then she's big on Tesla. So if you're interested in Tesla, but looking for another route of how you can invest in that company amongst others, then I would say ARK has been one of the best ones so far. So I really like ARK-K. It's focused on innovation. So Tesla and Square tend to be two of the larger holdings within that index fund or ETF. I would definitely put some more money into that. It's been easier for me to do it that way as opposed to trying to put a number of individual stocks in there, just because there's so many to focus on. So if you have narrowed down the companies that you want to invest into a handful, then sure, go ahead, use your HSA and your Roth IRA to invest in those individual companies on a regular basis if you see some promise there. But ARK-K has been providing good average returns year over year. It's an easy way to just kind of get your best returns without having to constantly manage the individual stocks that you put out there. That would be my tip for that one. And then for real estate investments, I've still been using Fundrise, but I kind of waved with that just with how the market has been limited in the real estate space. People are still investing and buying properties, but when you think about rent payments and how people will respond to this pandemic over the next couple of years, I think it'll get back to normal. But right now, we're still in this space of worrying whether or not people will be able to continue making their rent payments on time, if there's going to be any stimulus, right? Like, so at this point, I see the stock market as the best area for your returns in the immediate, or like right now, right? Like, it's still the best way for you to earn the best investment on your money, particularly when you look at these tech stocks and how the international markets have been performing. Like, I think that those are areas where you can see better returns than investing in different real estate options right now. So you're really just making a long-term bet once you put any money into real estate. I'm still thinking that I'll continue using Fundrise, and I still have funds that I have invested, and they give you the option to be a shareholder essentially in their what they call IPO, but it's like their internet public offering, not a IPO that's on one of the exchanges. That option is good if you think that they're doing a great service for the masses, right? That's another reason to at least get to Fundrise if you haven't. But in terms of just like international investments, companies like Mercado Libre for Latin America's e-commerce, and then for China, JD.com and Alibaba have been doing great over the last couple months. So if you can get in on any of those on a pullback, I would say that I've started positions and looking to add positions once it gets down to reasonable prices. And then one that I haven't gotten into, but I'm looking into, is Afterpay, which is an Australian payment company. Like, they help people to split up their payments, kind of like Affirm, which is another new company that's doing something similar. So those are areas that have been doing well during the pandemic because e-commerce and just payment processing online have been hugely necessary during this pandemic. And then, of course, you guys know all of the big names that everyone else has been mentioning. You probably can't go anywhere without hearing about them. So all of those could be good options for you, but I would say definitely try to wait for a pullback, because this week alone, the markets have been on a tear, just steady increases, and you don't want to buy at the highest point if you can avoid it. Out of the IPOs and SPACs, and there have been a number of them, like Lemonade is still promising, Zoomfo, Outdoor.com, that's still a SPAC under the symbol IPOB. and then UTS. Like I like all of those. For UTS, I would say it's not one that would be skyrocketing, but it's steady, and they're looking at expanding, so it can offer you some security, is how I would put it. But like I got in pretty early on that one, so I've already seen some return, but like in the next few years, I still see some steady increases. If you're looking for something that'll provide a little bit more of an increase, so double digit growth, I would go with some of the others that I mentioned. Definitely good options for you. And of course, Tesla is all things electric at this point. If you are looking at investing in a couple of whole shares, then great. If not, then fractional shares are still your friend. So, through a couple of platforms like Robinhood, like Charles Schwab, you can invest in fractional shares. I think even like Fidelity and Vanguard are on board with fractional shares now. So, if you don't want to pay over $1,000 for Tesla, well, now Tesla's in that 400 range, I guess, 400 or 500 range, but Mercado Libre is definitely over 1,000 right now. You could just put whatever increments you're comfortable with when you do the fractional shares. That's a good option there. There are tons of other companies that you can look into that will all benefit you well if you're looking at investing in some of these individual stocks. But if passive is your zhuzh, then I would say you can stick with some of these ETFs and index funds that'll give you that broad range. Arcus has been one that I like most just because it's an active ETF. So she's trading as companies share more and more information about what they're doing. But S&P 500 tracking is still what I'm doing for my 401k, but really that's in part because that is as aggressive as my company will allow me. So I go with that as the most aggressive option. But in other spaces where you can be a little bit more flexible, I'm doing mixtures of index funds and some of these individual stocks. Hopefully that piece is helpful for you. I'm going to go ahead and turn it over to Darian so he can share how his quarter has been going. But any questions, of course, you can reach out to us.
For me, I've still been using Robinhood as well as N1 Finance. One thing I like about N1 Finance and Robinhood, you still have the opportunity to refer people and get a percentage of money back when other people sign up. And also I like Webull too because they have different deals each week where maybe if you refer one person, you get 5 stocks. It's broken up into 2 parts. So they'll give you your first 2 stocks within the first part of the month, and then they'll give you the other 3 ongoing. So all 3 of those platforms I really do enjoy. And another stock that I've actually been enjoying right now is called Plug Power. I actually got it through a referral on Robinhood, but it's basically fuel and electricity and sales system. So kind of the same thing go along with like Tesla, but it's at a really, really low price right now of $17.10. When I first got it, it was like not even over $3. So it's been going up since then.
They're focused on that hydrogen power. So yeah, definitely if you could get it cheaper than 17, I'm trying to get in cheaper than 17 if I can. But go ahead.
But yeah, that's a great one. And then also I've been working on some IT things in the background. So I've been doing some studying for Security Plus. So another site that I've found is really helpful when it comes to just all different platforms, not just IT. It's called fatkiddeals.com. It has a lot of different things you can purchase on there at a cheaper price compared to having to pay a lot of money for different gadgets or even study material depending on what you're trying to do.
Okay, I think that's great. There have been great deals with platforms competing to get customers and more funds on their platform. Like on Webull, they've also had different offerings for tiers of funds that you bring onto the platform. And the same thing with M1 Finance. So if you are willing to move or invest money on their platform, they will give you either dollar amounts or stocks. And those are great ways to add to your portfolio without having to do too much work. But hopefully this has been helpful for you guys, and definitely let us know what you've been doing. And we'll talk to you again soon on Wealthworthy. Bye.
Bye.